This is an analysis from Alpha Business Media. Welcome to the deep dive.
Thank you. It's great to be here.
If you are joining us today, you are likely someone who wants to understand the hidden gears that make the global financial world turn.
Absolutely.
And today we are looking at a system that is complex, totally fascinating, and frankly, a bit alarming.
Yeah, that's a good way to put it.
We are exploring the global private credit market. I mean, it is a $3 trillion industry globally.
Great. The 3 trillion.
But to really understand how it functions and how it fails, we're going to look at it through the lens of an incredible high-stakes case study.
Nepal.
Exactly.
Nepal.
And that is the perfect place to start, because when you look closely at Nepal's financial ecosystem, you are not just seeing a local economic anomaly.
No, not at all.
You are getting a masterclass in how systemic risk builds up completely out of sight.
Right in the shadows.
Exactly. We are going to map out how traditional localized community lending has, over time, mutated into this vast, intricate shadow banking labyrinth. And our mission for this deep dive is to figure out how strict, seemingly smart banking regulations are actually inadvertently fueling this shadow system.
Which is the ironic part.
It really is. We are also going to break down a concept referred to in the research as the illusion of collateral.
That's a huge piece of the puzzle.
It's a structural flaw that is setting the stage for an inevitable economic reckoning. It is genuinely fascinating to see how well-intentioned policy can spawn these massive unintended secondary markets.
It is a classic tale of cause and effect in economics.
Definitely.
And the goal today is to help you, the listener, connect the dots. We want to take these specific localized practices in Nepal and show you the direct line between them and the kind of massive systemic risks that, well, they should keep any business leader or policymaker awake at night.
Okay, let's unpack this. Because when a lot of people in the West hear the phrase private credit,
They think of Wall Street.
right, they immediately picture multi-billion-dollar corporate firms in New York or London doing complex corporate buyouts.
Slick offices, huge legal teams.
Exactly. But the data we are looking at paints a completely different picture for Nepal.
Very different.
The Nepali version is fragmented, informal, and deeply embedded in daily life.
It's everywhere.
And the research breaks this shadow labyrinth down into 3 distinct layers. So let's start at the bottom. Layer 1.
Right. The foundational layer is what analysts call the hyper-informal sector.
Hyper-informal.
And we should be clear here, this isn't modern finance.
Right.
These are traditional practices that have existed for generations, like the rotating credit associations, which are known locally as liquidity.
Kukuti, yeah.
But they have been warped by modern capital demands. They are now being used to fund large, speculative commercial ventures instead of just community needs.
You also have high net worth individuals doing handshake loans.
Yes.
There is no formal underwriting.
Isn't that odd?
Just a verbal agreement and a basic promissory note called a tamasuk.
And the interest rates on these informal loans are staggering.
Oh, absolutely wild. The data shows they routinely exceed 36% a year.
36%.
But what I find most concerning is the enforcement. I mean, if this is just a handshake,
Right.
there is no legal recourse if a borrower defaults. Right?
That is the core issue. The enforcement mechanism relies entirely on social pressure.
Reputation damage.
Exactly. Reputation damage or, in some cases, outright intimidation.
Wow.
It is a completely closed, community-based network. And that means the systemic risk is totally hidden from the outside world.
Because it's not on any formal ledger.
Right. Think about the chain reaction here. A single default doesn't just hurt one bank.
No.
It cascades through a neighborhood or a business community, ruining dozens of individuals. But the broader market and the regulators, they have absolutely no idea it's happening until a major player publicly collapses.
Which brings us to the second layer. And this one seems to be causing the most immediate volatility right now.
It definitely is.
We are talking about the quasi-formal cooperative sector. Nepal has over 30,000 of these cooperatives.
30,000.
Holding the funds of millions of members.
And originally, these were community-driven concepts. They were intended to foster local savings and provide small-scale agricultural or personal loans.
Right, very localized.
But a massive portion of them have mutated far beyond their original mandate. They are essentially functioning as unregulated shadow banks.
How are they getting away with that? I mean, they are registered entities, aren't they?
They are. They are registered with specific government bodies, but crucially, they do not fall under the direct regulatory oversight of the Nepal Rashtra Bank.
The NRB.
Yes, the central bank. And because their internal governance is incredibly opaque, they operate almost entirely in the dark.
So they have free reign, essentially.
Pretty much. To attract capital, they offer unsustainable, Ponzi-like, high interest rates on deposits.
So they pull in all this expensive capital with high rates, but they have to generate the yield to pay for it.
Exactly.
The research points out they're taking that deposit money and lending it out for highly speculative ventures, mostly real estate and auto loans.
And that is exactly why there is an ongoing crisis right now. Hundreds of these cooperatives are failing.
Right now.
Yes, right now. Billions in depositor funds are completely frozen. This isn't a theoretical risk model. It is happening actively.
It's real time.
The cooperative crisis is acting as the canary in the coal mine for the entire private credit ecosystem in the region.
Let's move to layer 3, which is arguably the most complex. The data identifies this as the fastest growing and the most underestimated sector.
The digital shadow market.
Yes.
Yeah.
This includes unregulated buy now, pay later schemes and peer-to-peer lending happening directly on social media platforms.
Which is very hard to track.
Very. But the part that really caught my attention was the massive intercompany loan loops. It's a massive regulatory loophole.
It is a deliberate circumvention of the central bank's lending caps.
Yeah.
Let's break down how this financial alchemy actually works, because it is brilliant in a very dangerous way.
All right, let's walk through the mechanics. Imagine a large business group that owns a trading company and a separate real estate subsidiary. The trading company has healthy cash flows and is perfectly eligible for a regulated commercial bank loan.
So they borrow cash from the bank at a normal, regulated interest rate.
Exactly. But they don't use that money for trading.
No, they don't.
Instead, they take that legitimate regulated bank cash and funnel it over to their own real estate subsidiary as a high-interest, unregulated private loan.
And the reason they do that is because the commercial bank would have flat out refused to lend directly to the real estate subsidiary.
Because of the strict central bank caps on real estate exposure.
Precisely. They are essentially laundering the risk profile of the money, taking safe, regulated cash and injecting it directly into the shadow system.
It completely obscures the true destination of the formal bank's capital.
The commercial bank thinks it is funding a safe trading operation, but it is actually funding a highly speculative land deal.
So we have this massive unregulated three-layer cake operating entirely in the shadows.
A very precarious kick.
But shadow markets don't just appear out of thin air. They require massive demand. Why would any borrower, no matter how desperate, willingly agree to a 36% interest rate?
To understand the shadow market, you have to look at the macroeconomic forces at play. There are forces pushing borrowers out of the light and forces pulling lenders into the dark.
Let's look at the push first. Ironically, it stems from the success of the Nepal Rashtra Bank's recent monetary policies.
The anti-inflation push.
Yeah. The NRB has been very aggressive about curbing inflation and stabilizing the financial system. They raised interest rates, enforced strict credit-to-deposit ratios, and implemented rigorous asset valuation standards.
And while those policies protect the commercial banks, they effectively slam the door on small to medium enterprises and real estate developers.
Completely shut them out.
It is vital to note that these businesses are not necessarily unviable. A local trader needing working capital or a startup with a new model, they might have incredibly solid business plans.
Right, they aren't bad businesses.
But they simply do not fit into the new ultra-conservative risk parameters of the formal banking rules.
So, denied access to legitimate channels, they're faced with a choice. They don't just close up shop.
No.
They go to the shadow market out of absolute necessity.
Yeah.
They agree to 24 to 36% interest because the alternative is letting their business die right then and there.
That explains the borrowers. But the other side of the equation is just as important. Why is there so much capital available in the shadows?
Right. Who is funding this?
It is not just traditional loan sharks. Everyday savers and legitimate corporations are pouring money into this void.
Let's do the math on that because the pull for the lenders is fascinating. The research notes that consumer inflation in Nepal has been hovering around 8%.
Okay, 8%.
Meanwhile, a formal fixed deposit at a regular commercial bank might yield roughly 8% as well.
So they cancel out.
Wait, if inflation is eating 8% and the bank only pays 8%, why would anyone keep their money in a formal bank? You're basically losing money once taxes and fees hit.
You have hit the nail on the head. Your real return is negative.
It's guaranteed loss.
If you are an average saver or a business house with surplus cash, leaving your money in a formal bank means watching its purchasing power slowly evaporate.
It just drains away.
So when a private borrower or a cooperative in the shadow market comes along promising 20 to 30% returns, it becomes an almost irresistible magnet.
I mean, I get it.
People are making a rational economic choice to chase yield in an inflationary environment.
This brings up a really interesting comparison in the research regarding neighboring economies.
Yeah.
How does this situation in Nepal contrast with what is happening right next door in India?
What's fascinating here is the contrast regarding data infrastructure. India has undergone massive formalization over the last decade.
Right, huge digital push.
They implemented the Goods and Services Tax, or GST, and the Unified Payments Interface, known as UPI.
And those systems.
They created vast, inescapable digital data trails for millions of businesses and everyday individuals.
And because that data trail exists, formal lenders in India can look at a business's digital footprint, run it through an algorithm, accurately assess the risk, and extend credit to segments of the population that were previously invisible to the banking sector.
But Nepal does not have that comprehensive data infrastructure yet.
No.
A massive portion of their economy is still entirely informal and cash-based. Because the central bank lacks that granular transaction-level data, they cannot create nuanced risk models.
So they are forced to use blunt regulatory tools.
Yes. Think of a blunt regulatory tool like a sledgehammer instead of a scalpel.
Right.
Instead of saying, we will lend to this specific real estate developer because their data shows they are reliable, the central bank has to say, no commercial bank is allowed to lend to any real estate developer, period.
It's a blanket ban.
They tighten the screws on the few institutions they can actually see.
But by restricting the formal system without creating a data-driven bridge for these higher-risk ventures, the central bank hasn't eliminated the risk from the economy.
No, not at all.
They have just inadvertently squeezed it entirely into the unmonitored shadow reservoir.
Which sets up the most precarious dynamic of all, because when you lend someone money, especially in the unregulated shadow market, you want a guarantee.
You want collateral.
You want collateral.
Here's where it gets really interesting. This is where we get into the illusion of collateral. The research details a deeply ingrained cultural and financial belief in Nepal that land is the ultimate fail-proof asset.
It's rock solid, supposedly.
Land ownership is heavily intertwined with status and financial security.
Lenders in the private credit market operate under the assumption that their high-interest, risky loans are perfectly safe because they are backed by tangible, immovable dirt.
But the mechanics of how this collateral is pledged reveal a terrifying flaw. Let's walk through a hypothetical scenario of what the research calls the rehypothecation trap.
Okay, let's do it.
Imagine you are a real estate developer. You own a prime plot of land. You go to a Class A commercial bank, pledge the land, and get a formal loan.
Standard procedure.
The bank takes the title deeds, known as the Lal Purja, and officially registers the mortgage at the Land Revenue Office, the Malvat.
At this point, everything is completely above board. The commercial bank has a legally enforceable, registered first lien on the property.
Right. But a month later, you, the developer, need more cash. You can't go back to the bank. So you step into the shadow market.
You find a private lender.
You find a private lender, promise them a 30% return, and pledge that exact same plot of land as collateral.
But this second deal isn't registered with the government.
Exactly. It is just a private, unrecorded agreement, maybe a post-dated check and a Tamasuk promissory note.
And the private lender feels secure. They see the land, they sign the note, and they believe their investment is protected.
Then you get even more desperate. You go to a third private lender, then a fourth.
It keeps multiplying.
You're pledging the same over-leveraged piece of land over and over again to different shadow lenders, and none of them know about each other.
This highlights the critical blind spot in the system. In the formal banking sector, Nepal has a Credit Information Bureau, the CIB.
Right. CIB tracks all that.
If you try to take out 5 bank loans using the same collateral, the CIB flags it immediately. It acts as a central nervous system for formal debt. But the CIB has absolutely zero visibility into the shadow economy.
So you have an invisible web of overlapping claims. Imagine you are that third private lender. You genuinely believe you hold secure collateral.
You think you're safe.
But in reality, you hold a claim that is legally subordinate to the commercial bank and shared with 3 other shadow lenders. Your claim is practically worthless.
It is a complete house of cards built on a foundation of asymmetrical information, and it only works under one specific fragile condition.
Which is?
Land prices have to go up forever.
Ah.
As long as real estate appreciates rapidly, and the borrower has enough cash flow from new loans to service the old debts, the illusion holds.
But markets don't go up forever.
They certainly don't.
The research notes that Nepal's real estate market has recently stagnated. Liquidity is drying up. When the borrower finally defaults, all those shadow lenders rush to seize their safe collateral. What happens then?
They find themselves standing at the very back of a tremendously long, legally chaotic line.
Behind the banks.
And in the front of that line is the commercial bank holding the actual lal purja. The equity in that land, the value that the shadow lenders thought was protecting them, is almost certainly zero or even negative by the time the bank takes its share.
So what does this all mean? Let's look at the end game here. We have massive informal loans, astronomical interest rates, worthless collateral, and millions of everyday citizens and businesses tied up in it. How does a system like this actually unwind?
A reckoning is not a matter of if but how. Because the structural integrity of the system is fundamentally compromised, it won't be a slow, manageable deflation.
It's got to snap.
The trigger will be a singular shocking event, a major, highly visible real estate developer going bankrupt, or a massive cooperative network suddenly locking its doors and halting withdrawals.
Because the entire informal market runs on trust and handshakes. A single major failure shatters that trust instantly.
Precisely. Panic sets in immediately. Private lenders will try to call in their loans all at once. They will refuse to roll over existing debt.
And that causes the freeze.
This causes an instantaneous liquidity freeze across the entire shadow market. The businesses that rely on this revolving door of shadow cash just to make payroll or buy inventory will become insolvent overnight.
And that is how the contagion spreads from the shadows into the light. Those insolvent businesses default on their shadow loans, but they also default on their formal commercial bank loans.
If we connect this to the bigger picture, this is where we see what economists call the endogenous bailout playbook.
The government steps in.
The government's response is highly predictable, but it is complicated by the fact that they don't have direct regulatory power over the shadow lenders.
They can't just mandate things in the shadows.
They can't just bail out a wealthy individual who made a bad handshake loan. So the intervention happens in 3 distinct stages.
Stage 1 is mandated consolidations. What does that actually look like on the ground?
The government will identify the most systemically dangerous failures, particularly the large quasi-formal cooperatives that hold the savings of millions of ordinary voters.
Okay.
The central bank will then use intense regulatory pressure to strong-arm the healthy Class A commercial banks into acquiring these toxic entities.
Wow, forced mergers.
The commercial banks will be forced to absorb the bad loans and make the depositors whole. You are effectively taking private, unregulated losses from the shadow market and nationalizing them onto the balance sheets of the country's regulated public banks.
Which puts the healthy commercial banks in massive danger.
Huge danger.
That leads to stage 2, targeted liquidity injections.
The central bank knows they are forcing the commercial banks to swallow financial poison. To prevent the formal banking sector from collapsing under the weight of this toxic debt, the NRB will have to pump massive amounts of money into those commercial banks.
How do they do that?
They will likely do this by lowering the cash reserve ratio, or CRR.
For our listeners who might not live in the weeds of monetary policy, think of the cash reserve ratio like a mandatory emergency fund. It is a percentage of deposits that banks are legally required to keep locked in a vault, untouched.
Right.
By lowering the CRR, the central bank is basically unlocking that vault and saying, here, take this reserve cash and use it to keep the economy moving.
That is a perfect analogy. The central bank isn't bailing out the shadow lenders directly. They are frantically resupplying the commercial banks so that legitimate credit doesn't completely freeze up for the rest of the country.
And then comes stage 3, sweeping regulatory overhaul.
Crisis is the mother of regulation. We will likely see a massive crackdown.
Right.
The government will push for the creation of a mandatory national loan registry, forcing all those private, unrecorded debts out into the light.
They have to.
You will also see the central bank pulling all those large cooperatives and digital lending platforms under its strict, direct control. The harsh regulations that are politically impossible to pass today will become urgent, unavoidable necessities tomorrow.
This entire deep dive offers such a crucial lesson for you, our listener, especially if you are a business leader or an investor. We spend so much time stress testing our own balance sheets, making sure our own primary banking relationships are stable and secure.
But that's not enough anymore.
Exactly. What this analysis proves is that focusing only on the formal ledger is no longer enough.
The risk parameters have expanded beyond what is visible.
The real existential threat to your business might not be your own debt. It might be the hidden, unwritten 36% interest debts held by your vital suppliers, your biggest customers, or your joint venture partners.
And if they fail,
If a liquidity freeze hits the shadow market and their unrecorded capital evaporates, they go down. And if they go down, they might drag your perfectly healthy business down with them.
in a deeply interconnected economy, ignorance of the informal market is a profound vulnerability.
So, to quickly recap the fascinating journey we just took, we started in the deepest layers of Nepal's hyper-informal economy, looking at handshake loans fueled by social pressure.
The 36% loans.
We saw how strict central bank policies, designed to fight inflation, accidentally pushed viable businesses into the dark, while that same inflation pulled everyday savers right in after them in a desperate search for yield.
Chasing the returns.
We unmasked the terrifying mechanics of the rehypothecation trap and the illusion of land collateral. And finally, we saw the inevitable reality that the formal, healthy commercial banks will ultimately be drafted by the government to clean up the shadow market's toxic mess.
It is a sobering look at the real-world plumbing of modern informal finance and how risk never truly disappears, it just changes form.
It really is. Thank you so much for joining us on this deep dive. It has been incredibly eye-opening to unpack these layers.
And as we leave you today, I want to pose one final question to think about based on everything we've discussed. We've established the high probability that healthy commercial banks will eventually be forced to absorb the massive toxic debts of this shadow market to prevent a total collapse.
Right.
If that happens, what is the fate of the legitimate entrepreneurs and innovators of tomorrow? Will they find themselves starved of capital, unable to secure the loans they need to build the future, simply because the nation's banking system has been transformed into a giant, mandated cleanup crew for yesterday's unregulated greed?
Something to seriously mull over. Keep questioning, keep learning.